Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Profitability Ratios, your guide to financial success. Example, calculations. Now let's put these formulas to work with some numbers. Imagine you're evaluating a fictitious company, Acme Inc. Here's how you would crunch the numbers. Gross profit margin. Suppose Acme Inc. has a gross profit of $200,000 and revenue of $500,000. Calculation, 200,000, 500,000 times 100 is 40%. So Acme keeps 40% of its revenue as gross profit. Operating profit margin. Let's say the operating profit is $150,000. Calculation, 150,000, 500,000 times 100 in 30%. Acme maintains a 30% margin after covering operating expenses. Net profit margin. If Acme nets $50,000 in profit, calculation, 50,000, 500,000 times £100 is 10%. This indicates a 10% net profit margin, reflecting all expenses and taxes. Return on assets, ROA. Assume Acme has total assets valued at $1,000. Calculation, 50,000, 1,000 times £100, 5%. Acme's assets generate a 5% return. Return on equity, ROE, with shareholder equity standing at $500,000. Calculation, 50,000, 500,000 times £100 is 10%. The shareholders enjoy a 10% return on their investment. By understanding these calculations, you get a clear picture of how efficiently a company runs. It's like tuning into the heartbeat of a business, finding out if it's thriving or if it needs a doctor's checkup. So next time you analyze a company, grab these formulas and feel confident in your financial assessment. Analyzing profitability ratios. When running a business, understanding profitability ratios is like having a roadmap. These ratios tell you how well a company's making money compared to its expenses. Knowing how to interpret them can help you make smarter decisions. Let's break down some key aspects of analyzing these crucial numbers. Benchmarking against industry standards. Imagine trying to score a goal without knowing where the net is. That's what it's like if you don't compare financial ratios to industry standards. Benchmarking against industry averages shows how your company is doing compared to others in the same field. It can highlight strengths or pinpoint areas needing improvement. Spot weaknesses. If your profit margins are below the industry average, it might be time to look at cutting costs or increasing prices. Identify strengths, outperforming the industry. That's a fantastic sign you're on the right path. Stay competitive. By aligning your metrics with industry standards, you ensure your business keeps up with or gets ahead of the competition. Benchmarking isn't just about numbers, it's about knowing where your business stands in the bigger picture. Trends over time. Numbers tell a story, especially when you follow them over time. Watching how profitability ratios change can provide insight into a company's performance journey. Are things looking up, or is there trouble down the road? Consider these points when assessing trends. Growth indicators. Upward trends might suggest improving operations or market conditions. Warning signs. Declining trends can warn you of potential issues that require immediate attention. Informed decision-making. Trends offer a clear view, helping make decisions based on actual growth patterns rather than guesswork. Analyzing trends is like reading a map. It guides your decisions and helps plan your next move with confidence. Limitations of profitability ratios. While profitability ratios are handy, they're not the whole picture. Relying only on them is like watching a movie with the sound off. You miss a lot of the story. Consider these limitations. Non-financial factors. Ratios can't measure customer satisfaction, employee morale, or innovation. Market changes. Rapid industry shifts can make old data irrelevant. Different accounting practices. Variation in accounting methods can distort comparisons. Profitability ratios are essential, but they need context. Combine them with other metrics and qualitative insights for a complete business analysis. In the end, profitability ratios are valuable tools in your business toolkit. By understanding these numbers and their context, you're better equipped to steer your company towards success. Impact of external factors on profitability ratios. When we talk about profitability ratios, it's not all about the internal workings of a company. External factors play a significant role, shaping how these numbers shift and shake over time. Think of profitability ratios as a thermometer, and these external factors as the weather conditions that can cause the mercury to rise or fall. Economic cycles. Analyze how booms and recessions influence profitability. Imagine you're on a roller coaster. Economic cycles have their ups and downs, just like those twists and turns. When the economy is booming, everyone's spending. Companies see their sales skyrocket, and profitability ratios tend to glow bright green. Businesses often experience increased sales. Consumers have more money and confidence, spending goes up. Higher margins. With higher demand, companies might raise prices, boosting profit margins. Expansion opportunities. Companies might expand to meet demand, increasing revenues. But what goes up must come down. During a recession, it's like the coaster takes a dive. Spending tightens, and companies often face reduced sales. With less disposable income, consumers cut back. Lower margins. Companies might lower prices to attract buyers, reducing profitability. Cost-cutting pressures. Businesses might cut jobs or halt expansion to save costs. Have you ever noticed how companies tighten their belts when the economy hits a rough patch? That's the impact of economic cycles on profitability ratios. Regulatory changes. Discuss how changes in regulations can impact profitability metrics. Regulations are like the rules of a game, constantly evolving and influencing how businesses operate. Changes in regulations may seem like small adjustments, but they can ripple across profitability ratios. When new regulations pop up, they can mean increased compliance costs. Companies might need to spend more to meet new legal requirements. Changes in competitive landscape. New rules may level the playing field, or conversely, give advantage to some companies over others. Product adjustments. Sometimes businesses must alter their products or services to comply, impacting sales or costs. For instance, stricter environmental regulations might require a manufacturing firm to invest in new equipment, boosting expenses. On the flip side, deregulation could reduce compliance costs, boosting profitability. In this way, regulatory changes can hit like a curveball, challenging companies to adapt and recalibrate their strategies to ensure those profitability ratios don't dip too low. External factors are the unpredictable elements that can steer a company's success. By understanding these, businesses can better navigate through their financial journey. Understanding profitability ratios is like having a roadmap when you're on a road trip. They help you navigate through the complex world of business finances and make informed decisions. These ratios not only tell you how well a company is doing financially, but also where it might be heading. Knowing these can empower investors, business owners, and managers to take actions that align with their financial goals and ensure long-term growth. Why understanding profitability ratios matters. Profitability ratios are crucial because they shine a light on how well a company is turning resources into profits. Imagine trying to run a marathon without knowing how far you've gone or how fast you're moving. Wouldn't it be hard to know if you're making good time or pacing yourself correctly? Profitability ratios provide that information, helping businesses pace themselves and strategize effectively. Here are a few reasons why getting a grip on these ratios is important. Insight into efficiency. These ratios let you gauge how effectively a company uses its resources to generate profit. Investment decisions. Investors can rely on profitability ratios to assess whether a company is a good investment. Benchmarking performance. Companies can compare their profitability ratios to industry standards to see how they stack up. Strategic planning. By understanding these ratios, businesses can better plan for the future, adjust strategies, and set realistic goals, making informed financial choices. When you understand profitability ratios, you're equipped to make decisions that can shape the financial landscape of a business. Think of it like choosing which direction to go next on a road trip. Should you take a scenic route for better experiences or a faster highway to save time and resources? Allocating resources. Understanding which products or services are the most profitable can inform where to allocate time, money, and effort. Optimizing operations. Identifying areas of improvement can lead to more efficient operations and higher profitability. Risk management. Recognizing potential financial pitfalls before they occur can help in strategizing risk management. Understanding and analyzing profitability ratios is like having a tool set that not only repairs but improves the efficiency and strength of a business. They are essential for anyone looking to build a solid and thriving business strategy. Are you ready to dive deeper into your company's financial health and unlock its full potential? Profitability ratios hold the key. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.